Good afternoon, almost. Good afternoon, almost. We're going to get started in here in about 5 minutes, actually about 3 minutes. We got a bunch of people in the waiting room. We're going to get everyone in. Really excited about today's workshop. Thanks for joining us. We got a really great topic today, and I look forward to a great workshop, and hope everyone's having a great day. We'll be with you in about 2 minutes. Good afternoon, everyone. How's everyone doing today? I hope everyone's enjoying this. I'm not sure if you're in Milwaukee, but today is the day after the apocalypse or the snowstorm. It's sunny. It's a beautiful day here in Milwaukee, and certainly excited to be with everybody that's here today. We've got a great topic, which we're going to be discussing today, which is basically the BRRRR method of real estate investing. And, a lot of people have had a lot of different versions of what we would describe as the BRRRR method. At the end of the day, it's for us, it's basically how we got started in real estate. This was the,
yeah, it's not a new method, that's for sure.
Yeah, right.
But it's a buzzword.
Yeah, buzzword. So it added a little appeal to the BRRRR method, and it's BRRRR outside. So hey, how much more fitting could a BRRRR topic be than today? So just by way of introduction, we've got a few people joining us still, and we're going to be respectful of everyone's time. I'm sure some people are in their lunch hours, some people are at home, some people are in the streets driving for dollars, as they say, looking for the next real estate investment. So we appreciate everyone's time. We certainly want to be respectful of everyone's time. And so we're going to get started here in 1 minute. Mike, who's with us here, obviously, our MC extraordinaire, is going to be letting people in as the day starts. Any material that might have been missed will be shared with you following this session. Mike, let's get started.
All right. So today, just to kind of give you guys a quick agenda, we are going to share with you some terms that we'll be discussing, the strategy in general, and then we are going to break down the BRRRR strategy in total. So we will show you all of the different phases, and then kind of provide some insight on each of those different phases of the BRRRR strategy.
Yeah, great.
So it's just some quick rules of engagement. We do have a lot of material to cover. If you have questions that come up throughout today's workshop, please feel free to leave them in the chat. And otherwise, if something comes up after, you can always email me or email Sarah or email Scott, and we will get back to you. After today's workshop, everything that you see and hear today will become available online, as well as some additional resources that we're going to put out there as well to kind of help everybody get started or do more things, I guess, with the BRRRR strategy. So.
Yeah, great. Mike, we have a comment that some people are having issues hearing us. If you are, we apologize. We're continuing to work on our technology and hopefully you can hear us. And we'll do our best. So thank you for the comments. Before we get started, I just want to take 2 seconds to just share a very interesting book with each of you. The book is called Tools of Titans by the famous Tim Ferriss. We're reading it right now here at the office. It's basically a billion-page book that has different short stories in it, led by individual entrepreneurs and successful folks. The title is The Tactics, Routines, and Habits of Billionaires, Icons, and World-Class Performers. The reason I share it with you is, everybody wants to be that world-class performer. And this book really gives you some short stories about each person, their interviews, their discussion points, and Tools of Titans. If you're looking for something to read, jump on it. Pick a few great novels. It's about $20 on Amazon, and I think you'll find great value out of it. So that's that. As an introduction, my name is Scott Lurie. I'm with F Street in Milwaukee Hard Money. I've got the great, famous, infamous Sarah Floyd with us here. Sarah is going to help us moderate today's workshop. But we got a lot to cover, as Mike said. As part of the topic, we're going to be moving through some of the items. We've received a tremendous amount of questions pertaining to the BRRRR strategy, how the BRRRR strategy works. We're going to do our best to cover as much as we can in an hour. We also have just released a podcast. You can find, it's The Hard Truths with Scott Lurie. You can find it on Apple or any of your favorite podcast venues. And so feel free to download it. It's free. It's a great resource. And we obviously look forward to you hearing that from us as well. We just did a topic on the BRRRR strategy as a podcast, and I think it was a pretty great podcast. A couple of things we're going to discuss. Obviously, most people understand what BRRRR stands for, and it stands for buy, rehab, rent, refinance, repeat, right? Someone came up with this amazing acronym in our world. And as you'll see in real estate, we talk a lot about acronyms, right? So we got the ARV, the LTV, the LTC, the you name it, the DSC. We're very acronym rich in real estate. So a lot of smart people have come up with these acronyms. So, BRRRR strategy to me, when I got started in real estate, was not really a hot topic. What I called it at the time was basically leverage. And so leverage is really critical in what we're doing, right? Leverage is the point that allows us to do the important part of what we're discussing today, which is really the repeat, right? So how do we refinance, right? Or how do I, as a real estate investor, create leverage or the refinance? And so we're going to spend a little bit more time on that one particular module, so to speak, related to this strategy. But when we get into it, I just want to share with you today that taking out any current deals, we focus on getting to 100% leverage, meaning we want to use bank money, which bank money is our leverage point, and we want to get to as high of a leverage point as we can get with fiscally responsible logic so that we can continue to be disciplined. And so we're going to talk more about it as we get into this entire strategy, but discipline. You've got to be a disciplined investor like you would be in the normal fashion. Discipline is so critical to what we're doing. And I encourage each of you to take a method out of the earlier workshops, create a business plan. And in that business plan, make sure you're focused on discipline, make sure you understand your risk profile. And we'll get through that as well here when we focus on the refinance aspect of it, because we got a lot of great questions, and the questions that we've got that are really phenomenal as it pertains to what we're doing is really how do you get to the aha moment, the sauce, man? How do we hit the home run? And the home run for us is really how do we get to the end point And so in the world that we're in, obviously as lenders, we see a lot of endpoints, right? We see a lot of people that are taking us out through a resale, and we see a lot of people that are taking us out through a refinance. And the refinance is so critical. And so we're going to really focus on that. And we're going to help you do that. And if you have other questions after that, let's talk, because, the refinance is really the entire sauce here. And we'll get into that a little bit.
Yeah, like what we were saying is that we could pretty much spend 1 hour on each BRRR.
100%, right?
Like, how do I focus on the refinance, because that's very critical.
I totally agree. And we will be offering additional workshops. I always tell this 2-minute story, and I'm going to tell it again. The reason I'm doing this is for you. So, well, yes, we have an interest in a lending business. We are not here to sell anything. We are not selling our product. You will not hear us reference our product. Our product is important to the world, but it's not why I'm here. I'm here because in 2003, when I started with not a single piece of real estate, I did not own one thing. I did not even own a home. I rented an apartment. I did not own anything. I was wondering, how the hell do I get started? How do I get into real estate, right? I looked around and I saw all these wealthy people in real estate, and I'm like, God, that's where I want to be. So I went right to real estate, and I had no idea how to do it. And so I was always hopeful that somebody would help me, and I really didn't have anybody. And so today I'm here to help you. And so today, with 1,500 apartments that we have and own and manage that I have, and I'm building another 300 apartments right now and another 300 coming online and 1 million square feet of industrial. It's like, guys, I want to tell you, you sitting in your room wondering what can happen, you can do this. You can do this too. And we're committed to that. So if nothing more, I just want you to have the inspiration and the understanding that you too can do this. You can wake up tomorrow as a real estate investor and you can be successful. So to be successful, you have to have a lot of different things in your mind, but one of them has to be the confidence that you're going to be successful and the encouragement you're going to be successful. And so have the confidence you can do it. We're here to help you as a resource. We're located between Highland and Juneau on 9th Street. We're here every day. If you want to chat, talk, visit, we put on a lot of events where you can just come and open mic conversation with us. We've got more coming that Mike will be putting together. So please be active, man. Be your best advocate. And we're going to talk more about that in a little bit. So let's jump in here, okay? We're going to talk a little bit about the buy. I always, one of the people that got me started always told me, you make your money on the buy. And that's true. We agree. So you make your money on the buy and you realize your profit on the sale or refinance, right? So what does that mean in this scenario that we're at, right? On the buy side, if you were not to do the BRRRR strategy, but the fix and flip strategy, you buy something for $1, you sell it for $2, you're making double, right? And you have some expenses, so maybe you're making 50 cents. That's a good strategy. Today, we're talking about the buy as it pertains to the refinance piece of it. So you're building a rental portfolio. And when we do that, we talk about the refinance, right? How can we get stabilized debt on real estate that can essentially allow us to continue to do the last piece of this, which is the repeat, right? How can I repeat the process, right? I don't have unlimited funds. I don't have a tree in the backyard. What do they call it? The money tree? I don't have the money tree somewhere around town. So instead, I need to be able to create leverage points. And we're going to talk about that.
This is specifically great. And if you're just starting to really build your portfolio, great strategy for.
Absolutely. So let's talk about it. So the BRRRR strategy is built on the premise of buying to improve, right? We need to buy something to create what people talk all the time about, sweat equity, or we need to find something that we can buy and improve the value of it so we can realize a profit, right? So if we know that something is worth $100,000 on the ARV, if you buy it for $1, you have $99,000 and $99,999 of dollars that you can work through to get to your profit or to your leverage point, right? So the buy has to happen, right? So how do you buy? How do you buy? Well, you can buy simply with cash. You can borrow with private money or hard money or HELOCs or IRAs or 401ks or self-directed IRAs. There's so many amazing ways to buy. Be passionate about the buy. The buy is amazing. And, we trade real estate every day here at F Street. And part of what we do is we value the dollar. And you'll see all of the time as it pertains to folks that are focused on real estate. Let's trade you. I got a counter for $5,000 more. I'm just going to accept it. I'm like, dude, that's $5,000. And $5,000 should mean a lot to everybody, right? So be conscious of what you're doing, right? Be powerful in your approach to buying, right? Your most important piece of it is to be able to say no to a deal, not to overspend or to overpay. So it's very critical on the buy that you're doing your homework, right? When I was a franchisee of Homevestors, we were looking to write 100 offers a month, and we wanted to buy 3 houses a month. Think about the diligence behind that. I would write 100 offers. Sometimes it was 50, sometimes it was 30, depends on what you had. But you were only getting 3%, 4%. On a great month, you could get to 5%, right? Because you were disciplined in your approach, that your buy number was your critical point. So when you got here, if you bought below your buy number, you were making more money. If you started buying here, you were creating diminishing returns, right? Which was increasing your risk. So that didn't work, right? So be convicted to the buy. The buy is the most critical piece of this. It's not the most important piece of it, but it's the most critical, because if you overpay on a buy, or if you make a mistake on the buy, there is no refund, right? You can't take it back to, Kohl's on behalf of Amazon and say, hey, thank you, can you return this, right? They don't do that in real estate. Once you're the deed holder, you're the deed holder. There are no buyer's remorse clauses. There are no outs. Once you're the owner, you walk out of the title company, you are the owner.
And just to point out, because people may be looking at this list and thinking, well, where's the traditional lender on there? And I know Sarah kind of helped me put this list together, but this strategy, right, it focuses on actually not utilizing the traditional lender at this point.
Yeah. So the
right?
buy
that's
has
a different investment.
So the buy on the BRRRR strategy, or the buy on the leverage strategy, you have to get creative on the financing piece of it, right? How do you buy? Well, if you buy with traditional lenders, all you're creating is friction, right? So a traditional lender will say, well, you have to put 25% down, loan to cost, LTC, loan to cost, right? And you say, well, at 25% down, how do I get out of it? Well, there's a 5% prepayment penalty the first year and 3% the next year, blah, blah. It doesn't work for this strategy, right? So you have to be creative enough to find capital sources, whether it's a private lender, or a hard money lender, your HELOC lender, your cash, grandma's cash, mom's cash, brother's cash, who knows? All of those people can be important to your buy, right? And so the point of the buy is that we're going to focus on the refinance piece of it to get from LTC, or loan to cost, to LTV, loan to value. And so we're going to talk about that a little bit further in detail, but remember that LTC to LTV, that's your mindset, right? How do I go from the LTC, loan to cost, to get my lender to agree to the LTV, or loan to value? That's now we just put a little bit more stuff into the bowl, and we're about to make some cookies, right? That's the sauce, or the dough, if you want to call it, but we have to get there, right? And so LTC, loan to cost, LTV, loan to value. Okay, so talking about a little bit more about the buy, that's how you buy. How do you buy, right? People ask us all the time, how do you buy, right? There's many ways to buy. Find a wholesaler, go out and do your homework. How much energy, time, effort do you have towards the buy, right? There's MLS, there's brokers out there, there's wholesalers out there, there's opportunity out there, there's a million different ways. There's knocking on neighbors' doors, driving neighborhoods, there's 100 different ways. Online auctions, share of sales. There's a million different options underneath that. We'll discuss that in its own workshop at some point. But think about it like this. You have to figure this out. There are very successful people that we deal with every day that are buying 10 houses a month. And there are other investors who are contacting us every day saying, how do I buy a house a month? And I almost want to say, well, why don't you call that guy, because he's buying 10 a month? And instead of saying that, you say to yourself, well, what happens, right? And so that becomes the risk profile. And how does this person make this all work? And what type of work are they willing to take on? And so thinking about the buy, you have to get off the ground, right? We can help you with the buy, but we can only help you with the financing side of the buy. The way you find the buy is you have to go invest time, energy, and effort.
Exactly.
Time, energy, effort.
Get creative if you need to. Not everything is going to be found on MLS.
Yeah, and MLS is the lazy man solution, right? MLS. I wish we could come up with an acronym for lazy man solution, but we can't. But MLS, multiple listing service. Everybody has the ability to MLS. It's a public exchange, right? But are you looking at other opportunities? Pre-foreclosures, estates, probates. Share of sales. Are you going down to the courthouse? Are you looking in the Daily Reporter? There's a million opportunities there. So without getting bogged down into that one topic, the buy is critical. It is crucial. It is very important in what you do, but you have to drive the initiative. You have to have the self-starting motivation. Remember, real estate people are independent contractors, right? We don't get paychecks. I don't get a paycheck. We have to go out and earn our paycheck, and to earn it, you got to get off the sidelines to go do it. And so be prepared for that on the buy. So let's talk about the next thing. So we're going to talk about our favorite street, right? Of course, it's Main Street, right?
I've been on it before.
You've been on Main Street
I've been
before?
on Main Street.
Can you let those lovely folks in? The people on Main Street. So we're here's the deal, right? Here's a sample deal. 1, 2, 3, 4 Main Street, right? So let's talk about this. This is a duplex property on Main Street. The purchase price is $75,000. The repairs we're estimating are going to be $25,000, and the financing charges, whatever you end up using to pay whoever you end up using to finance money, or you can put it in your pocket if it's your own cash, is $10,000. So our all-in number is $110,000, right? Everyone get that math? 75, 25, 10, $110,000. We're all in. We anticipate, based on comparables, market study that we want to drive off of this, that the ARV of this property is
160.
well, $160,000. Okay. So in my mind, and once again, we ask this question all the time, who wants to make 50 grand? Me. I do. I hope everyone's raising their hand at home or the office or wherever you are. Raise your hand up high and say, I want to make 50 grand, because that's the reality of it, right? I want to make 50 grand. And if you don't want to make 50 grand, you can give it to me, or you can donate it like the gentleman in the stock market today to Barstool Funds, to that he just made $1 million off trading off GameStop. So thinking about it, the ARV 160, we want to earn $50,000 of wealth, and the monthly rent on this duplex is going to be $900 per side of the duplex. So we're going to be $1,800 a monthly income. Okay, so this is all diligence we've done beyond. So if you could buy today a house that's worth $160,000 for $75,000, would you do that?
Well, and let's talk about that, right? Because in this hypothetical situation, we have $25,000 we're putting towards repairs.
Sure.
What kind of repairs are we talking about here? We're not.
Yeah, so the repairs on this house are generally cosmetic at this point. You might be throwing a roof in there. You might be throwing a little bit of HVAC in there. This is typically going to be carpet, paint, some tiling in the kitchen and bathrooms to update those to modern status. So 25 grand can get you basically soup to nuts in that category. And we have received a lot of questions pertaining to how do I do the repairs? And we're going to talk about that on the next slide of the rehab, right? But if you think about it, this is just a sample deal, right? So we'll talk more about that in a second, but understanding where we're going with this, here we are, we've got this property. So they ask the question again, who would buy a house that's worth 160 for 75,000? Me. Okay. We all would, right? It's a good deal. We think that's a great opportunity. There's a nice spread in there, et cetera, et cetera. So going onto the rehab, right? So, oh man, this is an amazing topic. So think about the rehab. We talked about this before when we discussed risk profile, right? And I couldn't properly articulate it then as well as we're going to do right now. So take a look at this little diagram. Can everyone see the diagram? I hope you guys can. So the diagram basically says distressed asset is over here on my left, and over here is the ARV, right? And so somewhere in between there, so in the scenario we're using our sample, the distressed asset is a 75,000 and the ARV is all the way over here at 160. And so along that spectrum, we have to look at the different nuances of each transaction, right? So the lower you are on the distressed asset, or the lower you are on the purchase price. So let's just say that we ended up buying this for $50,000. Traditionally, we could expect the asset to need more repairs, to be in worse condition, to maybe have a foundation issue, Sarah's favorites. You could have a drain tile issue. You could have a magnitude of significant issues, right? But let's just assume for a minute, if you can just look at it on the left side, distressed asset, the farther you are to the left, the lower the purchase prices, the more work you have, the higher the risk, right? The risk is in the construction, it's in the rehab, it's in the challenges that are in front of you. And then you have what we would always say, the higher the risk, the higher the reward, right? So the lower you can buy it for, obviously the spectrum starts moving as you get closer to the ARV. Right? So if you buy a house that simply needs paint, right? The house is beautiful, but it's got some paint issues, right?
It's not very modern.
Yeah, but maybe it's modern. Maybe it's just the painting's not modern, but the house is fine, right?
But it's like these old yellows. So
yeah, the old yellows. So that could be an old yellow, and we have to do carpet and paint or paint. You would see yourself purchasing closer to the ARV, right? One could get more value, or one could see the value in the home selling for a higher price because it doesn't need as much work. So the farther you go across the spectrum, right, is the higher the purchase price, the less the work, the lower the reward, and the lower the risk, right? So some people might be on this this workshop today might have jobs, might have W-2 jobs, right? We might be saying, you know, I work 80 hours a week. I'm busy, but I love real estate. I don't know what it is about real estate. Everyone loves it. I love real estate. But if you think about real estate, right? So you're saying, well, I don't have time to manage these projects, right? I got time to call Carpet Land USA or John Smith's Carpet Company and John Smith's Painting Company and say, hey guys, can you put some carpet and paint in here before I go rent this duplex? Or I might put some flooring in the kitchen. Yeah, sure. And so, but you might be paying $110,000 for that house and your rehab might only be $5,000. Or you might conversely, just so we're on the same numbers, you might be paying $100,000 for the house and putting $5,000 into the house and get to the same number, right? You can still get to what we're trying to get to is the aha moment, right? The moment between which our all-in number and our ARV has a spread that's of meaning, right? So the delta between the all-in number and the ARV is what we're looking for, right? At the end of the day, that's the moment that we're saying to ourselves, yes, we did something, right? And we should all walk around and give each other high fives because that's the important piece of it, right? What is that delta? And so if the delta is you can buy an asset that's worth $160,000 that is in top brass shape that doesn't need anything for 110 grand, meaning you could do nothing, absolutely nothing, and walk into a house that's worth $160,000 for $110,000 and do nothing. Who's doing it? Me. Same thing, right? I don't want to do the work. The work's the painful part of it, right? Contractors are terrible. Can you let that gentleman or lady in? I'm not sure who it is. Contractors are terrible. They're undependable, unreliable. They have all of the problems that everybody has in the world. It's just exacerbated because you want your project done, right? So it's kind of a frustrating position. But if you're understanding the issue, right, the lower the purchase price, the bigger your opportunity is, right? To get to your all-in number, which is creating the delta between your all-in number, how much have I put in and invested into this property, all in versus the ARV, right? And so along that way, what you cannot do is lie to yourself. Oh, this thing's going to only take $5,000. And you know darn well it's going to take 20, right? Like, what's the purpose? The other thing you cannot do is fabricate what the ARV is. And so we have this conversation here all the time because as an asset-based lender, not to talk about the lendings, but just to talk about asset-based, we're looking at the ARV. And some people say, well, the ARV is 176 and the highest comp's 170. And so our challenge becomes, how do you suggest you're at 176 when your highest comp's 170? Well, my toilet is going to be better. Doesn't matter. Don't kid yourself, guys. It doesn't matter. My roof is going to be better. It doesn't matter. You need a roof on that house. So if you don't have a roof on the house is worth not as much. If you have a roof on the house is not worth any more, right? So it doesn't help, right?
We did a previous presentation too under the workshops about understanding after repair value you could reference.
Yeah, and so you can always go back and look at those. If you have any questions, we're available. But talking about the ARV, live in reality, right? But if you live in reality with yourself and you live in reality with the repairs with yourself, when you go to make your buy, that's the aha moment again, right? So if you told someone that the house is worth 176 to get your number up to buy their house for more money, the person you're buying it from is making more money and you're putting yourself in a bigger risk profile. Why would you ever do that? Well, I need a deal. Well, whoever said that? I mean, if you need deals, work harder to find the deals, right? Invest more energy in the deal, or obtaining the deal, but don't fabricate a deal. Don't create deals in your own mind. Well, my realtor told me. Understand your realtor gets paid only when you buy something, right? I love all of the realtors out there. I do. We're supportive of them. We think they're wonderful. Just remember, as a realtor, you have a fiduciary to your client to give them good data. And most of the time they do that, right? The world is good most of the time. Just be conscious of it, right? Just be cognizant of the notion that do your homework because, and this happens 100 times a day, right? 100 times a day. My realtor told me this thing's worth X dollars. Oh yeah? Have you looked at it? Well, they told me. Well, what if they told you everything else underneath the sun, like go jump off the roof, go do all these things? Would you do them? Of course not, guys. This is your job. This is your way to build wealth. Do your homework. Look at the CMA, right? How did they get to the valuation they're driving for you? They created what they call a CMA, right? It's a document that they should provide you that gets to a valuation. You should be able to look at it with great diligence and either A, determine the number is accurate, or B, determine the number is not accurate. The idea is to make it work, right? You want to make it work, but you want to make it work so you're not stretching so that your spread at the end of the day, which we're going to talk about here at the refinance component of it, when you get to that point, you need to have enough spread from your ARV to your all-in number. And if your all-in number is 155 and your ARV is 160, Houston, we got a problem. Okay. So don't BS yourself, right? It doesn't help anybody. It just doesn't. So amazing.
Again, the risk profile, like if you are looking at property and you don't want to do any of the work and you just want to get a property that's already fixed up, you are going to be prepared to pay closer to market value. And this is not the best strategy for you.
Correct. And so we see that all the time. Well, the house is in great shape and I'm paying market. Well, then you're fine. Then you're just a conventional buyer, right? You should be prepared to, the BRRRR strategy is not really for you, right? You have to be able to buy this distressed asset to create the value, to get to an ARV, to create the spread. The spread has to be available.
That's not to say that you're not a real estate investor, though. It's
no,
just
there's a different strategy for everything, right? I mean, this is a simple strategy that if you're not able to create a delta between your all-in number and the after repaired value, you're just doing something else. And that's okay, by the way. It doesn't make you good or bad. It doesn't make you right or wrong. I know a lot of people, and those are the people that are out there today buying East Side Milwaukee or downtown Chicago apartments, and they're paying 4 caps. They're looking to just earn a little bit of a return. That's not what this is. This is very specifically creating a delta, a spread between your all-in number and the value of the property.
Yeah.
Present value today, not, well, tomorrow, if the market keeps going up, it's going to be worth more. No, stop doing that.
And then
So
leverage.
right. So live for today. So the next piece of this, obviously, is this is the buy and hold strategy to some level. And we're going to talk briefly about the rent, right? And so, my God, I mean, I remember renting apartments, renting duplexes. The 37th in Glendale was the first one, and 8 families following by 400 units after that. And you know, renting is awesome, right? And I remember the days when you're like, oh, someone's got $600 to pay me in cash. That's amazing. And you're like, let's go get it. And you went over and you got $600 and you put it in your pocket and you're like, this is really dumb. Yeah. Okay. So think about it, guys. Spend the time to find the right tenant. Not necessarily the first tenant, right? The first tenant doesn't make this strategy right. Oh, I rented it and I got a tenant in 1 hour. Yeah, who's the tenant? Oh, good question. I don't know their name. They just moved in. I gave them the keys. They gave me $1,000, or they gave me, in this scenario, $1,800, $900 to move in, $900 for security deposit. Or, oh, I didn't even check security deposit. Or I didn't even get a security deposit. Stop exactly right now. Remember this. After you've just gone through what is described as, okay, a blood, sweat, and tear remodel, right? You've
6 months, 5 months, whatever,
2 months, a week, 3 months. You've dealt with 3 contractors. You've used all of the swear words under sun, and you've made up 3 more, right? Now you're about to do.
Now you're an investor.
Yeah, now you're an investor, right? But now think about what's going to happen. You're about to relinquish control of your property to a tenant. Don't you want to know who that tenant is? Don't you want to know where that tenant works? Don't you want to know if that tenant actually does work?
Yeah, you definitely don't want them to trash your unit. You just got to
Yeah,
fix
right.
it.
How would you know if they trash it? Have you done a background check? Have you done a tenant verification check? Right? Well, what does that all mean? What does that all mean, right? Let's talk about this. So think about this think about it like this. You're relinquishing control, right? You want to know everything about the person you're relinquishing control to. And when they start getting edgy, when the warning signals start flying, they're not by accident, right? Hey, let me do a background check from you. Okay, so some of the points that we use to avoid a bad tenant, right? We do a background check. Okay, so in the background check that we do, we check CCAP, right? It's public record, right? So what we're looking for under CCAP is a thing called SC in the case number, and that means small claims. And all evictions fall under the category of small claims on the initial first cause, right? So there's first and second and third cause. So under the first cause, you would have an eviction, right? And so that would be under SC. So when you click on SC, you type in the person's name. Now, remember, people might say, well, my name is John Smith, right? How many John Smiths do you think there are in Wisconsin? A billion? Okay, so John Smith, we need you to fill out, let's go back from it. Fill out an application. There are 1 million applications online.
We're going to share one, actually.
Yeah.
Like after this.
So as part of our data source that we're going to give you is we're going to give you an application, right, to use. But use the application. And they say, so what we require is that anybody over the age of 18 complete an application, because multiple people living in multiple houses in the same house, we want to know who they are, right? We have this happen all the time. So make sure you're screening everybody over the age of 18 with an application, right? Can you charge an application fee? Of course you can, right? Can you pay a service to do the background check for you? Absolutely. They're $30, they're $20. Find them online. There's a million different services, right? But get an application, get a picture of their ID, right? People will tell you a false name. It happens to us, I don't know, 100 times a day. But and this isn't our management company, but you have to weed through that, right? So we need a copy of your ID. We need a copy of your application. Well, I'm not able to fill the application today. Listen, sir, I'm not able to complete the application today. I'll do it tomorrow. Is it okay if I give you money and move in and I'll get you the application? No, it is not. That is a red flag, guys. So slow down a minute, okay? You'll get to the money. You will get to the money. But if you put a bad tenant in your house, that all that money you spent, the 25 grand could turn into zero. You could go like this, 25 grand, zero, 25 grand, gone, just by a bad tenant. So do not do that. So do a background check, right? What we require, can you let those people in? What we require in our world is we require 3 times rental income, right? So monthly income needs to be 3 times monthly rent. So verify that, right? How do you do that? Let me see your paychecks, right? Does their paychecks look like they made it on a printer? We have been provided with false paychecks, okay? So yes, it does. It's true. Make sure that you are setting a precedent. Now there's fair housing laws that are out there. I am not an attorney, but check the fair housing laws. But if you're disciplined and have a structure for all of your properties, you will follow fair housing. You cannot make an exception for John, and for Sarah, she gets a different exception, right? You need to be consistent in what you're doing across the patterns of everything you do in life. And so we also will not let someone move into one of our properties that's had an eviction in the past 5 years. There are no exceptions. Well, that wasn't really an eviction. Okay, what else would you call it? Well, I moved out and I moved to Illinois. And when I came back from Illinois, I had an eviction on my record. Right. Okay. Move on, right? That either shows you're an irresponsible person or it doesn't work. But we do not allow for anyone to move into one of our properties that's had an eviction for past 5 years. It's just a policy, right? Period. It's non-negotiable. Well, it's been 4 years and 3 days. Sorry. You got to be disciplined, right? There are a million tenants out there, a million. You will find a tenant if you're doing your homework. But if you put a bad tenant in your property, you will be living the proverbial nightmare. It does not end. So pay attention. We just as a business point, we do not accept cash payments. We only accept certified funds or money orders. And the reason for that is that we deposit every dollar we get into our bank account because our lenders want to see the income. So will your lenders when you go to do your refinance. So if you say to your lender, hey, this person pays $1,000 a month, where's the money? Well, it's at this restaurant. I bought some dinner. I got some flowers for my friend. I don't know. It's all over the place. They don't care. They're going to say, well, since we cannot verify that you've received this income, we cannot support you. We cannot help you with the refinance. So do not make any shortcuts there. Okay. And then the last thing is,
it's easier on that part, right? Than when you guys started. I mean, there's Venmo now. There's PayPal.
Yeah, there's Venmo. Just do it digitally. Just be efficient. There's Cash App. There's so many different payment sources. Do not take cash. I know it's easy to. And the easy thing is, I'm back on my rent. Oh, here's $1,000 for my rent. I'm sorry. We do not accept that. They understand that. They want to have a roof over their head and they want it to be a quality house. So that's what you offer. Now, one other thing you have to remember is that there's the ability to call the other landlord, right? Hi, Mr. Smith. My name is Scott. I'm looking at John's application to rent from me. Do not rent to John. John is a nightmare. Okay, right? They'll tell you that. When people call us, we tell them what happens. It's a fiduciary to our community to be honest with everybody. So be honest with people, okay? But as a landlord and as a landlord on both sides, be honest to both sides of the equation, right? So be good there. All right, let's go to the next page, which is we're going to just touch on briefly because we're obviously running out of time because we only have an hour and we want to get to the sauce piece of this. Are there any questions, by the way? We haven't stopped for one of those in a minute. Anyone have any questions? I want to type it into the message. Mike will articulate it back to us, and otherwise we'll keep moving. But how many people are there?
58.
All right, well, we got 58 of you listening in today, so happy listening in. So how do you determine rental rates, right? This is another important piece of this whole entire sauce, right? So the end of the day, the valuation is driven off of two things, right? the ARV, the after repaired value, right? So you'll see an appraisal that will come in and do simply a comparable valuation approach, right? As a comparable valuation approach is pretty easy. What houses have sold in the general area and what's the value, right? Commercial lenders will also sometimes use the approach called the income approach, right? An income approach directly relates to your rental rates. And so I'm going to encourage you to not leave any money on the table, right? It's so easy. Well, will you take 750? I'm asking 800. No. Will you take 775? No. Well, why? What does it all matter? Well, go back and look at some of the other workshops we've done pertaining to the leverage point of it, because it dramatically impedes your value. It lowers your value. The lower your income, the lower your value. There is no way around it, right? I can conversely say that the higher your expenses, the lower your value. So when somebody says to you, "Hi, Sarah, I'll rent from you, but I don't want to pay my water bill." Sorry, either do I. Who's using the water? Well, I am. Well, why wouldn't you want to pay for it? Well, my neighbor down the street doesn't, the guy down the street doesn't charge for water.
Got to go live there.
Well, then go live with him, because I need that, because that is an expense, right? $400 a year of water expense is harmful.
It's an exponential amount, actually.
Yeah, it's exponential based on the capitalization rate. And if we look at the capitalization rate, we're like, holy smokes, this is a big number, right? So think about it. So how do you determine the value? Drive your neighborhood before you make the buy. Call the signs that are in there for rent. Hello, I'm John. This is Scott. How much you would rent the place to me for? Well, it's a 2-bedroom, 2-bath, and I'll rent it to you for $800. Okay, that's house next door. That's pretty good comparable. And then you can use the online resources, right? Zillow, Craigslist. There's a million different resources you can use across the platforms to find the value. But what I want to tell you under my pro tip, which is so critical that everybody will take the first offer, right? And this is where you need to have your diligence, is maximize your rental rate. Do not leave money on the table. It really adds up. Like, it really adds up. As part of your lease rate, also make sure that the tenants are paying utilities. The tenants are paying water. It really adds up. So if you think that not paying water is, I don't know, $400 a year, right? You're reducing your rental rate, or you're increasing your expenses to reduce your NOI. Do not leave money on the table. Be diligent in your ways. Okay? This is critical. All right. Oh, yes. Why are we in blue? Should be in red. This is kind of I guess the red looks better, or the orange.
I was trying to make the colors pop.
All right. Good attempt. We'll take it from there. So guys, let's talk about this. This is the aha moment, right? This is the sauce. This is the home run. This is where every investor should be striving to get to, the refinance, right? You might strike out here 100 times, guys. That's okay. It's the ones that are successful at this notion of the refinance are the ones that are successful. So how do you do it, right? How do I do this? So we talked before a little bit about LTC to LTV, right? And so if you ask a lender, I bought a property and I would like you to appraise it to give me my value. They might say, well, when did you buy it? And they might say, well, we can only do LTC, or a loan to cost. And you're going to say, thank you, have a nice day, right? And there's a lot of things that go into that, because what we're seeking is a lender who's willing to offer us a loan based on the value you have created, the LTV, right? Because if they do LTC, all you're doing is you're going to get a loan based off the $110,000. But what we need to get is a loan based on the $160,000. Okay, this is the critical moment. This is the moment where we need to figure out, how can we solve this problem? And it's kind of, this is on you, right? So let me start by saying to you that we will be providing you with a couple lenders that we work with in the commercial sector of this space, right?
Yeah,
and
actually, I got the list here, but
yeah, well, we'll share them with everyone after this. But there's a couple lenders that do this. We're going to give you some of those lenders. Please reach out to them. If you let them know that Scott and Sarah from Milwaukee Hard Money sent you over, I don't know what it'll get you, but hopefully it gets you a response, right? So lenders are lenders, right? Lenders are people. They're human beings just like you and I. Get to them, okay? Befriend them. Take them to lunch. Visit with them. Can I come and meet with you for coffee? That's not a strange request. Okay? You should spend 1 day a week visiting with lenders, identifying new ones, finding new ones. I found a new lender I've never seen who's coming to my office today at 1:30. I'm having a cup of coffee with him right after this. I've never heard of them before, and they're like a $20 billion bank. How is that possible? We've been doing this for 20 years because it's possible. There are banks everywhere.
Tons.
So be part of it. Be active. I said to the guy, hi, can you come to my office and let's have a cup of coffee? How does Wednesday at 1:30 sound? I said, well, good. Perfect. I look forward to seeing you. And so he's coming today at 1:30. So the reason I say that with you is every day I'm still meeting with new lenders. You should be too. You never know. To continue to build your portfolio, you need lenders. So establish this relationship with the lender. Okay. So how do you do this, right? So the goal for us is to get to the loan to cost, right? So loan to value. So if we can get a loan, and traditional fashion is 70 to 80%, and right now they're closer to 70 of the price of the loan to value of the 160. There's a scenario to which we could, depending on the 70 to 80, we could get all of our money back. We could be 100% leveraged. That means that you've made an investment in June, in January, 6 months later, you've done the entire process, and now you're going to refinance and get all of your money back. Right? You're going to pay back your hard money lender. You're going to pay back your private lender. You're going to pay back mom, dad, brother, sister, aunt, uncle. Who cares? Okay. There's also a scenario to which you might not be able to pay them all back. You might have a small deficiency. And then you need to be a disciplined investor to use your cash flow to build the trust of them as you continue to move forward. And we're going to talk about that as well. But think about this. How do I do this, right? Everyone asks, how do I do this, right? Here's what you have to do. You need to prepare a request for financing. You need to have a place to send it to, right? But start with the letter. I will provide you after this with a copy of one of mine. It'll show you what I write to my lenders, whether I'm refinancing a duplex or I'm trying to build the 134 units in Brown Deer or in Oak Creek 648. We write the same letter. Dear lender. And we're asking for the same thing that you're asking for. But if you're doing what everyone else is doing, and let me tell you what everyone else is doing, nothing. All they're doing is they're picking up the phone and they're saying, hey, can you refinance this? Who are you? I don't know. Who am I? I have no idea. And then the relationship's never off to the start, right? Except when you send them a letter. There is a letter that we'll show you a little bit here, but it's not the real letter. Yeah. But the letter needs to say something like this. Dear Mr. Banker, I bought 1234 Main Street. I paid X amount of dollars for it because it was a distressed asset. Let me show you some pictures. Include the pictures, right? Let me tell you, over the past 6 months, Mr. Lender, Mr. Banker, I have done the following. I have put a roof on the property. I've installed a new HVAC system. I have installed new electric. There's new carpet. There's new paint. There's new flooring in the kitchen and the baths. The place is amazing. Let me show it to you and show them pictures. Invite them to the property. I'm happy to schedule an on-site tour with you today. You know how many lenders I've walked through my properties? Hundreds of them. I go every single time to those meetings. Those meetings are critical. I go. You go. Mr. Lender, can you come with me? Sure, I can.
Yeah.
And when you get
Go
through
to the appraisal.
always the appraisal. Go to everything, guys. This is the sauce, man. How hard are you going to work for that 50 grand? I'm going to work my ass off. You better too. So don't lose sight of this. Write this letter. Let me show you the renovations. I have all of this done. And Mr. Lender, you will not believe this, but I have rented it to 2 individuals that are now paying on a year lease, $900 per month. They're paying 100% of the expenses of the property. They are even doing the snow and the grass as contracted in our lease. Here are the leases. Please see attached. Mr. Lender, what I'm asking you to provide me is a loan to value based on what I believe the ARV to be of $160,000. You're spoon feeding this to them. Here you go. Eat this, drink this. Here's my comparables. My comparables are based on the 3 houses selling next door to it are $160,000. Shove it down their face, not disrespectfully, but with confidence, with 100% conviction, and with facts, people. Use the factual data that you want. Be disciplined, but show them the information, guys. Oh, then the lender can look at something and say, tell me more, Scott. right? Oh, and Mr. Lender, by the way, P.S. I've been trying to meet with you. Do you have time tomorrow morning for coffee? Right? These letters are disciplined, right? This shows the lender that you actually care, that you just, instead of woke up this morning and said, hey, I'm going to go try to get some financing. It says, hey, I've done my homework. I've done my due diligence. I've invested time. I went through, Mr. Lender, I went through 27 rental applications before I got to my tenant because these people weren't qualified. That's important to them. That says you care, that your lights are on, that you know what's going on, that you are part of the solution, right? You are creating your own destiny, folks. It's critical to that. The other thing to consider is understand that you want to express that you're seeking a loan to value. And so some lenders have an issue pertaining to what we're going to call seasoning. And so no, it's not the everything bagel seasoning, and it's not salt, and it's not pepper. Seasoning is essentially another industry word for how long have you owned the property. Some people require 6 months. Some people require 12 months. But you need to know that up front. So if you start making introductions to lenders today, you know that John at PNC Bank requires 6 months seasoning, and you know Nick over at Waterstone Bank requires 12 months seasoning, and you know where to take your asset, right? If you have a 9-month rehab because it's got a lot of work and it's going to take you 3 months, you don't really care about the 6 months. The 12-month might be a better rate. You don't know. Know what's going on. Get into the business, guys.
Is the seasoning ever based on how long you've had tenants in, or
No.
is it just on the ownership of the property?
It is nothing. It's only on ownership.
Okay.
Right. So now there are some covenants that might require a lender to say, we will require you to show 3 months of income. So they call that trailing income or trailing dollars.
They want to see the money coming in.
Yeah, but and they don't want to see it going into your pocket. They want to see it going into a bank account. Wash it through your bank account. And I say wash it, but run it through your bank account, right? It touches your bank account. Be diligent. We talked about accounting of real estate all the time. It is so critical that what we're doing is running a professional business. If you're not running a professional business, you will never be successful in this business. You might have great strokes of luck. You will never be disciplined. And so run a professional business. It's that simple. So let's talk about that for a minute. So then the other thing you can provide them is a pro forma, right? So we've submitted a pro forma to a bunch of people. If anyone needs a pro forma, we'll send it out again. But if you run a pro forma, here's my value. I mean, here's my income. Here's my expenses. Here's my NOI. At a cap rate equal to what I think based on the comparable markets are 7 cap or an 8 cap or a 6 cap or a 7 cap or 9 cap. The valuation on the income approach is $194,000, blah, blah, blah. Right? You can do that. Give them all of the data. Don't let them create their own subset of data, because they'll do that and they'll look at it and say, I'm not interested. Thanks. Or it'll just get deleted. But if you can go through the process of helping them, and that letter is the help, right? The data is the help. And so the other thing is we're going to talk about a little bit is how do you talk to multiple lenders? You send this letter out to multiple people, right? Because remember, you've had coffee now with 20 different lenders, and there's 100 different lenders. So talk to them. And then you send it out to all of them, and you blind copy everybody. You don't need to send it out to one. Dear lender, please see attached letter, and please provide a term sheet by February 5th. Okay. You'll get responses. You'll be amazed. You're going to open up your email on February 4th, and there's going to be a response from XYZ lender. Hey, I'm here. Here's your term sheet. And you're like, whoa, it worked. And I'm like, yeah, darn right it worked. People, what you have to understand is that bankers are in the business of lending money. That's their business. So when you provide them with a request for a term sheet, you're asking them to do their job, right? People get lost in the translation of what everyone's doing in life. That's what happens. It's like when you ask a realtor for a CMA, they give you a CMA. You're like, yeah, that's great. I need a CMA. Okay. So another thing to consider as I want is build relationships with your lenders. Be your own advocate. It's okay to be a little bit of a nudge, right? It's okay. Like, hey, you know what happened? And you always in your mind come up with your own scenarios. Oh my God, he just got eaten by the dog. He hasn't called me in 3 days. The dog ate him. And you're like, and you call the guy and you're like, hey, are you okay? Did the dog attack you? And he's like, you won't believe it. I've just been out. I had influenza. Well, not this year, but whatever it might be, so people are people. We just have to remember, you have to be your own advocate. You have to be out there. You have to be writing these letters. You have to be sharing the data. Go out and take your pictures. Go out and be your advocate. It is so critical to what you end up doing.
One might say no, another is ready to say yes. You
Yeah, and
never
as soon
know.
as they
There's
say
different
no,
guidelines.
you should arrogantly say, that's a mistake. How do I get you to say yes? This is the best deal ever, right? Keep being your advocate, right? It is not a bad idea to be your best advocate, right? Listen, you just told me you can't. What can you do, right? What can you do? We want to know that, right? And that tells them a lot about you as a character. Like, this person is diligent. This person's persistent. We get people that call us that, submit a loan application, and then they call 27 times. I'm like, God, that person is so, and you want to say annoying, and then what comes out is persistent. Or, God, that person is so, they're going to be a good payer. They're confident in what they're doing. And so be your best advocate, guys. Any questions, Mike?
We did have one for first rentals. Do you guys recommend a property management, or should they be doing it on their own?
Yeah, great question. So when I got started, I did it on my own. I did it on my own for about 100 to about 100 units. And then I started hiring a property management company that I actually just built myself. Nobody's going to do as good of a job as you. Let's agree to that, right? Nobody cares about your duplex as much as you do. So think about it. If you care about your duplex and you want it rented to the right person and to the management and build a relationship with your tenant, I still have tenants from 2004 that still live with me, that still call me. It's fine. Hi, how are you? What can I do for you? You're my customer. You pay $800 a month every month, $7,200 or $8,400 a year, or 96 or whatever the numbers are. How can I help you? I just wanted to say, hey, and can I get my rental certificate for the year? Of course you can. Be your advocate. Be involved. I would recommend running, depending on your job, depending on what your time frame is, be your own property manager when you get started.
One good tip is that there is a landlord training class. I believe it's free. That
it's
City
free.
of Milwaukee,
City of Milwaukee
puts
offers
on.
it. Yeah, it's
It's
great
a
one,
full
Sarah.
day, and so that'd be definitely something I would do getting into it.
Yeah, and that's a great recommendation. There's also a lot of other organizations. There's the Milwaukee RIA that you can. There's a landlord compact. There's the Association of Apartments. There's so many different organizations. Be active, guys. Be part of them. If you're too busy to be your own advocate, no one's going to help you. You're going to be helped on your own. So I would say to you, that's kind of you need to be your own advocate. Getting to the last piece of this, just in an effort, we got about 4 minutes here. So, there's a couple different scenarios that we're going to look at, right? But let's look at it. The ARV is 160. If you refinance a loan for 120, right?
You get your 75% ARV.
75% of your ARV, you're getting 100,000. You're getting 100% of your money plus $10,000 back. All right. So this is called a cash out refinance. These are not as popular as they are today. They still happen every day though, but they're not as popular. Okay. But a cash out refinance, you would get $10,000. Now, who's going to take that $10,000 and go buy some champagne at the nightclub and do stupid stuff with it? Nobody should be raising their hand. It should be going back into your business. It should be going back into your business account so you can repeat. Remember, we have to do a repeat, right? We want to buy 10 houses. We want to buy, I see all a long time online. I'm on my 25th rental property. I'd want to jump through there and give you a hug. I'm like, you are amazing. And that person that's on his 25, I promise you, is not frivolous with his money right now or ever. So think about that. The second scenario is that you only get $104,000 back, right? You're $6,000 deficient. And we're using these numbers as placeholders, but understand these numbers spread, right? You might be able to get back more. You may be able to get less. The notion is if you're short, what do? Right? So if you're using your money to cover some of this, then you're $6,000. And maybe you've got a job and you're saving $20,000 a year. And so you can do 3 properties a year. Clap for yourself. That's amazing. You might say, I don't have the money disposable. I'm kind of trying to figure it out right now, but I want to keep doing it. And I'm really good at this, or I really love this. Well, maybe mom is willing to borrow you the money. And what you need to be doing is figuring out that of your free cash flow, right? I earn X amount of dollars of free cash flow. Of the free cash flow, I'm going to pay mom back a disciplined amount every month on the 15th or on the 1st or on the 10th, whatever the day is. And so consider that you need to be disciplined, right? The repeat piece of it is how do you do it, right? So there's other ways to do it. I every day am raising capital, right? For my real estate projects. So I'm using OPM or other people's money. I'm paying them a preferred return. They're getting equity in the transaction. They sometimes control the transactions, right? But that allows me to do deals. And so that's okay. Everybody in the real estate industry are using other sources of capital besides their own. And they're not always 100%, right? Some people create partnerships. Some people create operating agreements that have limited partners and GPLPs, whatever you end up with. There is no solution to it, but what you need, there is no defined solution, but what you need to have is a way to repeat. And the way you're going to repeat, the way you're going to do it is to figure out the money piece of it. OPM, partnerships, grandma, mother, brother, uncle, private financing, whatever it might be. I can assure you this. Whatever you might see on late night TV that says you can do this with no money, please get that out of your head. You need to have capital, right? Figure it out. Figuring out the capital piece is great. What does it say? HELOC or
investment loans? Yeah,
great. Jump on a HELOC, right? I've got a HELOC on my house that I can borrow 50 grand on. Let's just say, okay, use that. Use that. That's great. Then you take that, and then in 3 years, if you're so disciplined to this, that in 3 years, you're not going to be using your HELOC. You're going to be using your savings account, right? That's the trick, right? You've got to figure out how to leverage. I will tell you that there's on Milwaukee Hard Money's YouTube channel, there's a leverage video on a property that we did in Shorewood a couple of years ago, and it's been viewed over 40,000 times. It's not by accident, people. People want to know how to leverage. You want to know how to leverage. Everyone's interested in it. Leverage, but not irresponsible leverage. I want to say that to you 1,000 times. Do not be irresponsible. Be a professional.
That was in the podcast too. When you guys go check out the podcast, right?
Yep.
It was always make sure you're making your payments.
Yep. And so on the last sheet right here, how disciplined can you be with your cash flow, right? If your monthly payment is $607, plus you have to pay your taxes, and you're bringing in $1,800, let's just say you're making $1,000 a month of free cash flow. How many months would it take you to pay back that $6,000 you owe mom? Yep. You got it 6. Or maybe you only want to pay them $500 a month. It'll take you a year. That's okay. But be disciplined, be committed to what you're doing. You have to figure out how to get from loan to cost to loan to value. It is the aha moment, right? There are lenders that are out there. They all will say, well, we're going to require for us to get from a loan to cost to loan to value, 6 months seasoning, 12 months seasoning, 3 weeks. We don't even care. We'll go right to loan to value. You have to find those guys. And so with that, it being 1:00 on the beautiful Wednesday afternoon, I want to thank all of you for being here. We're going to send you all this information. You guys, I want to continue to remember that investing takes money, takes energy, and takes professionalism. All of you that have joined today are on that method of trying to be a professional real estate person or already are. We encourage you to keep doing it. If there's anything we can do for you to help you, Sarah, myself, or Mike, please reach out. I'm Scott at F Street Group, Sarah at F Street Group, Mike MD at fstreetgroup.com. We're located between Highland and Juneau. If you ever want to stop by, please feel to visit our website, MilwaukeeAirMoney.com, and ask for an appointment. We will meet with you whenever. Okay, you don't need to be a customer. We will meet with you. Come talk to us. We do that all the time. We have lunches and coffee at the office all the time, and we'd love to see you. Obviously, we want to be respectful of social distancing, and we obviously want to do our part to limit the spread of the pandemic. So anything we can do to help you, though, whether it's a Zoom call or not. Thank you for being here. We wish you the best in your investing, and I hope you guys have a great day. Anything we can do to help you, we're here for you. Take care. Be well.
Thanks, everybody.